Today, we shall be talking about the factors that influence the rate of exchange. Now, what is the meaning of rate of exchange? We have already uploaded videos regarding the same. Kindly have a look. In brief, I will tell you, it is the value of one currency which is expressed in terms of another currency. For example, if I make an equation is rates of like $1 is equal to 70 Indian rupees. So this is the rate of exchange being quoted amongst the currencies of two nations. Today, what are the factors which influence this rate of exchange? Why is $1 is equal to 70 rupees and why not 60? Okay, so these factors will be discussed in detail. The market rate of exchange or the day-to-day rate of exchange is subject to fluctuations. It's very simple and it's clear to everybody that this is very dynamic and a very volatile rate of exchange. It keeps on changing and fluctuating within minutes. Why does it happen? It happens in response to the changes in the supply and demand for international money transfers. When we study the demand and supply of a commodity, we determine the price of that particular commodity. Similarly, here also, in the market rate of exchange, there are so many factors which are responsible for the supply and demand for international currency, international money transfers. We will be discussing them in the slides to follow. There are a host of factors which influence the supply and demand for foreign exchange. It is due to these factors that the rate of exchange keeps on fluctuating and varying. Let us begin. Now, the first point mentioned here is the trade movements. Trade movements here means imports and exports. We do sell our products to other country and also other countries' products are being sold to our nation. So, due to the change in the balance of imports and exports, there is the change in the demand and supply of foreign exchange. Sometimes the demand for foreign exchange rises and at other times the supply rises. It is the cause of the fluctuations in the rate of exchange. See, if the imports of a country are more than the exports, okay, imports are exceeding the exports, then what will happen? The demand for foreign exchange will rise. The demand for foreign exchange increases because you will be importing so much of products, and when you will be paying for that imports, you will be needing foreign currency, right? You have to pay in dollars when you purchase a product from outside your country. So to pay off that imports, you will be needing what? You will be needing the foreign exchange. Therefore, the demand for foreign exchange will rise. Now, what will happen? The rate of exchange of the native currency will fall. Your Indian currency will fall because there is so much of imports. To pay off, you need dollars. The demand for dollar will rise and your currency, home currency, will fall. The rate of exchange will move against the native currency if the imports exceed the exports. Clear? Now, in the second segment, if the exports are more than imports, what you are exporting is more than what you have imported. In that case, the demand for foreign exchange decreases because you will not be needing more and more dollars to pay off for your imports because your imports are less as compared to your exports. So what is the net effect? The demand for foreign exchange will not rise, it will fall. Therefore, the rate of exchange of the native currency of your home currency will rise. The rate of exchange will move in favor of the native currency. Your Indian currency will rise in comparison to dollar. So here is the flow chart regarding it. If imports are more than exports, then the home currency will fall. Rate of exchange will move in favor of the foreign exchange currency. And in case your exports are more than imports, right, then your home currency, Indian currency, will be more stronger. Rate of exchange will be in favor of your home currency. So this is, now you can very well imagine why so much of importance is given to exports. What is the Indian government trying to tell you all over the years? So you have to focus more on exports. Don't import the goods. It's better you buy your own domesticated goods from India. Why so? Because by doing so, you are strengthening the position of Indian rupee in comparison to dollar. Clear this point? Now, another related concept here is the balance of payments. Balance of payments on the current account is usually considered as X minus M, which stands for exports minus imports. Now, in case 1, we take that exports is 100 and imports is 80. In this case, exports are more than imports and the balance of payments come out to be 20 surplus. If we have surplus, then our currency will appreciate. People's interest in our country's currency will rise. All over the globe, when we are talking about exports and imports, the people in other country, they will be having more interest in our country's foreign currency. The rate of exchange will be in our favor. So if balance of payments, the net balance of payments is in surplus condition, that means exports are more than imports, then our currency, Indian currency, will be in a strong and favorable position as compared to the outside world. But in the case 2, if the balance of payments is not in your favor, in case exports is less and imports are more, that means say 20 is the deficit. Now, there lies the problem. If this deficit is financed by our own resources, then nothing to worry. If the Indian government has that much wealth, that much resources to finance this 20 deficit, still there is no point to worry. But the worry arises if this deficit is financed by foreign capital. You don't have anything in your country, and to overcome this deficit you need foreign capital, then the condition is not very suitable. The currency, your home currency, will depreciate in this case and the rate of exchange will be unfavorable. Your country's currency will go down as compared to dollar. Okay, so there are two cases. One, when the balance of payments is in your favor, and the other one when the balance of payment is not in your favor. Now, the second point as regards to the factors due to which the fluctuations of rate of exchange take place is the capital flow. Capital means wealth, money, right? Now, the capital flow from one country to another country brings changes in the rate of exchange. Whenever there will be the capital inflow or outflow from your country, there will be a variation in the exchange rate. See, if the capital is exported from America to India, dollar are coming to India, in that case, the demand for Indian rupee will increase in the foreign exchange market. Therefore, the rate of exchange of Indian rupee in terms of American dollar will rise. You get your dollars into your country, your rate of exchange will be favorable to you. Capital flow from USA to India, exchange rate of rupee of dollar, it will rise, rupee will be appreciated in the world market and exchange rate of dollar will fall. So that is a favorable condition to your home currency. Rate of exchange stands in favor to Indian rupee. Now next comes the granting of loans. If a country gets a loan from a foreign country, the supply of foreign currency will increase. Supposingly, America is giving a loan to India. We have so many dollars in our country, right? The supply of foreign currency, the supply of dollars in my country, it will increase. Therefore, the rate of exchange will move in favor of my home currency and against the foreign currency. It is just a related concept to the capital flow. If by any chance, even if for loan, the dollars are coming to Indian currency, what will happen? Home currency will be strengthened. Home currency will be appreciated in the world market. Rate of exchange in favor of home currency and rate of exchange not favorable to the foreign currency. Granting of loans, dollar coming into India, favorable position. Okay. Now, what will happen if the reverse? At the time of repayment of loan, when you are paying it back, or when you are granting a loan to any other foreign country, to any other underdeveloped country, when you are granting a loan, then the supply of foreign currency will fall and the rate of exchange will move against your home currency and in favor of foreign currency. So this is just the opposite of the previous slide. When you will be granting loans to some other underdeveloped country or you will be repaying the loan, then the rate of exchange will not be favorable in the home currency and it will be favorable for the foreign currency. Fourth point comes out to the sale and purchase of securities. Securities, I mean here international securities. The sale and purchase of foreign securities influence the demand for foreign exchange and hence influence the exchange rate. So the first step comes out to be affecting the demand for foreign exchange, foreign currency. Once that demand is affected, definitely the exchange rate is also affected. How it happens, let's study. When the residents of a country purchase foreign securities, supposingly Indian residents are there very much interested in investing abroad, in purchasing the securities of some other nation, then what will happen? The demand for foreign currency increases. They need dollar to pay for the investment in those securities. How will they invest in the foreign securities? You cannot pay in rupees, right? You need dollars. Now, therefore, the demand for dollars will increase because people have to pay for it. Hence, the value of home currency will fall. Rate of exchange move against the home currency and in favor of foreign currency in case the residents of a country wish to purchase foreign securities. So again, the governments have been again and again emphasizing, please invest in India. If you invest in India, you are making your rupee more stronger as compared to the world market. Okay. Now, opposite of this will happen if foreign residents will be investing in India, then rupee will be more strengthening, rupee will be more appreciated, and the rate of exchange will stand in favor of Indian currency. Now, the point number 5 is the banking operations. See, the banks deal in foreign exchange. What do they do is they sell drafts, transfer funds, issues letters of credit, LOC, you must have heard about it, and accept the foreign bills of exchange. They do all this. When a bank issues drafts or any other credit instrument on its foreign branches, it increases the supply of home currency in the foreign exchange market. When the dealings of the banks happen abroad in say for America. Now, the supply of your home currency in the foreign exchange market, it will increase because the bank is issuing the draft for their bank is transferring funds. In this case, the rate of exchange moves in favor of home currency gets strengthened and it moves against the foreign currency. Your rupee value is appreciated in this case. Now, the sixth point is speculation. Now, what is the meaning of the word speculation? Means anticipation about the future changes and earning from that anticipation. Because of the fluctuations in the exchange rate, you will be earning. So, this is called speculation. Now, the speculation in the foreign exchange market causes variation in the rate of exchange. We are studying the factors which influence the exchange rate, and this speculation is also a very big factor. See, if the speculators expect that the value of foreign currency is going to rise, if their predictability power is telling them that dollar is going to rise, rupee is going to fall, what will they do? They begin to buy foreign currency in order to sell it in the future to earn profit, because their anticipation theory is telling them that in the forthcoming months, in the near future, the value of dollar is going to rise and rupee is going to be depreciated. So in order to earn money, in order to earn the profit of this fluctuation, what will they do? Right now, they will buy the dollars because they are at a cheaper rate in comparison to future. And they will wait for the time when the dollar gets expensive and then they will sell it. So now because they are going to hoard the dollars, they are going to buy foreign currency, what will happen? They tend to increase the demand for foreign currency. In the home market, the demand for foreign currency will rise and it will raise the value of the dollar, and the rate of exchange, it will move against the home currency. So this is how the speculation is going to affect our Indian rupee. And if the speculators act this way, they hoard dollars to sell it in the near future to earn profit out of it. What are they doing? They are going to depreciate their own rupee, right? So it's a very important point. Next, if the speculators anticipate the fall in the future value of the foreign currency, if they predict that in the forthcoming months, in the near future, the dollar is going to fall, what will they do? They will sell their foreign exchange holdings. They will sell it right now because it is going to fall. As a result, this increase in the supply of foreign exchange the rate of exchange, it will move against the foreign currency and in favor of home currency. So this speculation also manipulates the dollar and rupee value. No doubt, exports, imports, all these are very important. But if you judge the position right now, even if we are laying more emphasis on exports, but this speculation, again, it's going to ruin our money. So that is a little, painful. But anyways, we are discussing the points which affect the rate of exchange, and speculation is one of them. I've made it clear to you. Next is the protection, point number 7. When the government of a country gives protection to the domestic industries, it tends to discourage imports from other countries, right? The government every now and then keeps on coming up with so many policies, so many protections, so many subsidies which it provides to the domesticated industries. So if it happens, the domesticated products, they will be available to the normal people at a normal rate, at a subsidized rate, or at a cheaper rate as compared to the foreign products. So what will happen? People will buy from their own home market. So this government policies tend to discourage imports. When the imports will be reduced, the demand for foreign currency will decrease. Rate of exchange will move in favor of home currency because you will not be paying for your imports. You don't need dollars to pay for imports. Okay, so the demand for foreign currency will reduce, and therefore rate of exchange will move in favor of home currency. Rupee gets strengthened. Okay. Next, exchange control. See, the changes in exchange rate is also brought about by the policy of exchange control. Usually, various measures of exchange control involve restrictions on imports, which lead to the fall in the demand for foreign currency. If the government is making restrictions on imports, there are so many items which governments come from time to time that this can't be imported. There is a very big taboo on falani things import and all. So it moves in favor of home currency, right? Because the demand for foreign currency will fall. You don't need dollars to pay for imports. What will happen? Exchange rate moves in favor of home currency. Home currency gets strengthened, gets appreciated, and the value of dollar will fall. Okay. Point number 9, very important, inflation and deflation. The changes in internal value of money, that is the inflation and deflation, also reflect themselves in the similar changes in the external value, that is called exchange rate. Now, whatever is happening inside the country, it can be inflation, it can be deflation. This internal changes in the value of money will affect the external changes. External, here I mean exchange rates. So inflation and deflation have a very big impact on the exchange rate fluctuations. Let us take an example that there is very low rate of inflation in India. This will lead to low rate of products, that is the goods and the services, they will be available at comparatively cheap price in India. मान लीजिए example that there is very less inflation. Okay, so the price of the Indian products, they will not be expensive, they will be cheaper. So what will happen? People from other countries will prefer to buy the goods from India because in India you are getting these products at a cheaper rate. Foreigners will definitely buy from India because it's not highly priced. These people will have high demand for what? For Indian currency, because they are going to buy from India. They will create a very high demand for Indian currency. Value of Indian rupee will rise and Indian rupee will be appreciated as compared to other currencies. Exchange rate in favor of Indian currency. So what I'm going to tell you is that this less inflation rate acts as a magnet to the foreigners to buy the products from India, which is a very big benefit to maintain the exchange rate, and the rupee gets strengthened. During inflation, the internal value, that is the purchasing power of home currency, falls, and what happens? All the goods and services, they are very expensive. So what will happen? Outflow of foreign capital from the country to avoid financial losses. Okay, to cover up for this financial loss, there will be outflow of foreign capital from the country. As a result, the demand for foreign currency will increase and the external value of home currency will fall. The rate of exchange will move against Indian currency. Now, when we say that inflation, when I use the word inflation in this context, we talk of the comparative rate of inflation between other nations. Taking a very simple example, say that the country called K is having an inflation rate of 20%. Now 20% rate of inflation is too high. But if I compare to another country, say S, which is having an inflation rate of 23%. Now the previous rate is not that high in comparison to this rate. Okay, so whenever we will be talking about the inflation rate in today's article, it means the comparative inflation rate as compared to other countries. We take the relative value, we don't consider the absolute value of inflation in this regard. Now, see, during deflation, the internal value, that is the purchasing power of home currency, rises. The purchasing power of your Indian rupee will increase when there is deflation. There will be inflow of the foreign capital to realize the financial gains from the relative appreciation of the value of foreign currency. This is just the opposite of what I told you in the previous slide regarding inflation. Here the internal value of the home currency will rise. Inflow of foreign capital to India, what will happen? Your currency, home currency will get appreciated. The change in the exchange rate in favor of home currency and against the foreign currency. So there is a little flow chart regarding this. When the inflation is at a lower rate, the country's currency will appreciate, foreign exchange rate will be favorable to your home country. And when the inflation is on a high, the currency, your home currency will depreciate and the foreign exchange rate will be unfavorable to your home currency. Next point is the financial policy. The policy of deficit financing leads to inflationary conditions in the country. So, if the government is restoring to deficit financing, it has so many repercussions. So many things are affected by the policy of deficit financing. There will be inflationary conditions prevalent in the country. The foreign capital will start leaving the country. The supply of foreign exchange will fall. Rate of exchange will in turn in favor of foreign currency and against the home currency. Next important point comes out to be the bank rate. The changes in the bank rate causes fluctuations in the exchange rate. Now see, when the central bank of a country raises the bank rate, okay, there will be inflow of foreign capital with a view to earn higher interest income. If your country, the interest rate is high, so people from other countries, there will be an alarm for them. If want to earn more profit, everybody wants to earn more rate of interest. So foreigners, they will be investing in your country to earn higher interest income because they know that in India, the rate of interest is very high. So the people from other countries will come forward and they will invest in your home country. The demand for native currency will go up. In this case, foreign capital, you are attracting foreign capital in your country by providing a higher rate of interest. Your country appreciated. In this case, if the rate of interest is high, your country's currency will be appreciated. This is also called hot money flows. Okay. Now, as a result, the supply of foreign currency increases in India. Rate of exchange moves against the foreign currency and rate of exchange is in favor of home currency. But on the other hand, if the bank rate is reduced, if the interest rate is reduced, there will be an outflow of foreign currency. People will not be investing in your country because your rate of interest is so low. The exchange rate, what will happen to the exchange rate? It will move in favor of the foreign currency and against your home currency. So here's a small flow chart. Bank rate rises, exchange rate will be favorable. Bank rate falls, exchange rate will be unfavorable to your home country. Now, next is the peace and security. If you have to invest in a country, there are two options, say A country and B country. Which one will you choose? Country A, if it is facing a problem of security with the neighboring nations, there is so much hassle, there is so much little firing is going on, you will never prefer country A. On the other hand, if B is a peaceful nation, on the terms of peace, you will prefer to invest in country B. Okay. So, the conditions of peace and security in the country will definitely affect the foreign capital. This increases the supply of foreign currencies in the country. In case your country is a peaceful country, you will attract foreign capital. Foreign currency will be available. The increases. Hence, the rate of exchange move against the foreign currency and in favor of home currency. So, if it is a peaceful nation, then foreign exchange rates are favorable to that nation. So the peace of a country also affects the exchange rate fluctuations. Now comes the political conditions. Political stability also encourages inflow of foreign capital in the country. If there are internal wars happening, the people are fighting, there are clashes, there are like blasts going on everywhere inside the country, nobody will be ready to invest in your country. Right? So the supply of foreign currency will increase if there is politically stable country. Elections are held according to the 5-year term plan. There are no religion conflicts. I hope you understand what is the meaning of political stability. If there is a country which is having a stable political condition, there will be inflow of the foreign capital and the currency of that country will be appreciated and strengthened in comparison to dollar. The value of home currency will fall if there is no political stability. Okay. Now, political stability, if it is there, then that means the exchange rate is favorable to your own home country. Next point is the monetary standards. If a country is on the gold standard, then the exchange rate will move within the limits set by the upper and the lower gold points. If you are moving on the gold standard, the exchange rate will just vary in these upper and lower gold points. On the contrary, if a country with inconvertible paper money system is there, then there is no limit. The exchange rate can move either way anyways. Next point is that all these factors which we just discussed, they cause fluctuations in the exchange rate. Now, if the country adopts the policy of complete exchange control, the exchange rate is pegged at a certain level. Then there will be no variations in the rate of exchange. But all these factors discussed today definitely affect the rate of exchange. And here we come to the end of the article. I hope I have made the things very clear to you. In case you have any doubt, kindly feel free to ask me in the comment section. Like and subscribe to my channel. Thank you for watching. Stay safe, stay blessed.